Hello, everyone. Today I want to talk about detailed explanation of the randomized control experiment performed by the authors of the book Poor Economics. It's going to get real academic today, but bear with me. I think these informations are very useful and interesting. Firstly, it is important to understand that a randomized control experiment, or RCT, is in general in the medical field research a technique used to assess the effectiveness of the medical treatment. As Philip Oswald, who is the author of the book The Code Economy, a 40,000 year history, puts it, firstly, the steps are to randomly divide the experimental population into treatment groups that receive benefits from the program and a control group that doesn't. Secondly, assess outcome for both groups, and lastly, determine whether or not a significant difference exists between the two groups. This method is borrowed and employed by the authors of the book Poor Economics, Abhijit, Banerjee, and Esther Duflo in the field of development economics in finding answers to small questions that are related to poverty. For example, do countries who receive foreign aid grow faster than those who do not? What kinds of aid are more successful than the other? Is a way to prevent malaria is by trying to reduce long-term poverty through health investment, such as providing a free bed net or access to water and sanitation. What are the reasons given the very high risk of weather fluctuation on crops that still do not make the poor more interested in buying insurance? Why haven't farmers used free fertilizer knowing that more fertilizer will yield more harvest? Or what kinds of development do women in positions of power care more than men's? In order to adjust policies from these incremental answers by slowly understanding the ways they are from data gathering and comparisons. The purposes are to implement large-scale experiment designed to test their theories, to help us make sense of the previous past from data gathering, to understand the key problems, and to find a way to solve and to observe behaviors of people in comparable groups in order to analyze effects or effectiveness of the treatments that will impact the subsequent responsive solution and decision making, whether they be about the discourse and direction of policy, the amount of aid next round, other or more interventions, and next experiments. Although the main disadvantage of this book is that because what happened in these randomized control trials, for example, to understand how the poor make decisions cannot be subjective to only the people in a trial or of an internal validity, of which cannot be generalized nor universalized assuming from just a number of people in a trial, even in a repetitive manner or in various locations, because humans are simply a multidimensional being who are born in a multidimensional environment. Therefore, the book statements are based on assumptions. There were many RCTs performed by the authors, but one of the significant ones is the correlation between microfinance and transformation that I want to talk about. The evaluation of the Spandana program performed by the authors in some areas of the city of Hyderabad, out of 104 neighborhoods, 52 were chosen at random for Spandana to enter. The rest were left as a comparison group. Some 15 to 18 months after Spandana started lending microcredit, there was clear evidence that microfinance was working. People in the Spandana neighborhood were more likely to have started a business and more likely to have purchased large durable goods such as bicycles, refrigerators, or televisions. Households that did not start a new business were consuming more, but those who had started a new business were actually consuming less, tightening their belts to make the most out of the new opportunity, less tea and snacks. However, there was no sign of a radical transformation. They did not find that women were more empowered nor better spending on education and health. It was working, but not miraculously. It helps to fight against poverty, but not enough, argued by the others. As a result, they believe that microcredit has its strengths and limits. They found that more families did not start a business given that they had a better chance to access to capital at affordable prices. For some, it is on the rigidity and specificity of the standard microcredit model requires. I mean, group members are responsible to keep each other accountable, and that method of constant weighting required by microfinance institutions of joint liability and the different level of entrepreneurship possessed by each individual makes joint liability less effective for those who want to take risk. Microcredits don't offer emergency loans as much as often as money lenders, so the model is quite stringent. For example, frequent repayments and not set up to torrent any failure, such as bankruptcy. But microfinance institutions believe that letting their guards down can result in disastrous consequences, which in a way makes them similar to banks, working in an environment where they have little recourse if a client decides not to reimburse or repay them back. However, gradual trust can be built over time, which helps reduce reliance on joint liability. However, a study found no difference in repayment whether clients are formally under joint liability contracts or not, as long as they continue to meet regularly. Social connections within the group do not build up as fast, and eventually default rate do creep up. If the way to keep borrowers accountable is by joint liability, therefore the way for borrowers to repay is also in believing that others will repay, and I shall get a loan in future. It produces a logic that my action is related to other people's action. The others found out that collective responsibility can be fragile when it comes to changing beliefs. In Krishna district of Andhra Pradesh, an organization's credibility can be crippled by news, for example, of farmers committing suicide or local inference, politicians trying to kill microfinance institution competition, which can result in defaults of many believing that repayments are not necessarily, as there is no future within an institution. When such a situation happens, there is a room for some to be unpaid. What if it can happen several times? One led to bankruptcy once in 2008 of KAS. Besides strengthening repayment discipline, the microfinance institutions model is not tolerant to entrepreneurial failures, which is different from many in Silicon Valley who felt many times as repayment are needed, argued by the others, which is not a natural way of finance entrepreneurs. Most microfinance institutions disapprove of borrowing to buy consumption goods. Some actually put a lot of effort into making sure that their money gets spent on some income earning assets. The stringent rule that enables microcredit to lend at low interest rates define this, which incentivizes clients to play safe and not take risk. The solution to this is to borrow a microcredit, grow your business, and move to a bank, argued by the others. They found that Spandana program, after 18 months, the first round of the loan, totally monthly spending on wasteful expenditures went down 100 rupees per family. For those who receive extra microcredit loan, or about 85% average of what they normally spend. Less spending equals more saving from a low interest rate loan. At the end, you can use data gathered from different RCTs in different areas to analyze from years to years to see what factors make them distinct or similar from one another. They argue that good policies come from good analytical RTCs that can help to sort out the political process. RCTs help answer small questions, and the others believe that incremental progress and changes and accumulation will lead to a quiet revolution. RCT help come up with a better goal and solution as well. Rigorous empirical testing, such as RCTs, will allow us to not only construct a toolbox of effective policies, but also to better understand why poor people live the way they do. With this patient understanding, we can identify the poverty traps where they really are and know which tools we need to give the poor to help them get out of those, as small changes can have big effects.